Okay. This module, accounting and financial and management accounting, we will go through financial statements, financial ratios, budgeting, and cost analysis. In this session, we will go through what is accounting. As we know, accounting is the language of the business because it tells us how efficiently our company or business was performing last year, 2 years ago, or previous years in general, or for one specific period. What is accounting? Accounting is identifying, measuring, recording, and communicating information. So who are the users of this information that we are providing? It can be owners, customers, competitors, government, for example, because they want to know that if we are paying our tax accurately or no, suppliers, because they want to check our credit and our accountability. Or they can use it like for investors, and they want to do investment analysis in order to see if we are doing well or if we are doing better than our competitors to make investment in our company or not. Accounting informations, they should be comparable. So we should compare it with previous years or with the other companies in the same industry. They should be verifiable, timeliness, and understandability. Financial accounting. What is a financial accounting and what is management accounting? Financial accounting presents the financial health of an organization to its external stakeholders. Who are the external stakeholders? The investors, creditors, government, banks, etc. And what is management accounting? Management accounting focuses on the current and future, and they don't have anything to do with the historical data. And mainly they are using those statements and provide those information for internal users. What do? They do planning, forecasting, cost accounting, decision-making, budgeting. They are all in the area of management accounting. Financial accounting seeks to quantify, interpret, summarize, and communicate the financial transaction of a business for external and internal stakeholders. Focus on recording, analyzing, and reporting. In general, there are 3 financial statements, which are including income statement or trading and profit loss account, a statement of financial position or balance sheet, cash flow statement. What is a statement of financial position? A statement of financial position shows the financial position of the company at one certain point between 2 periods, over a period. For example, from 2021, from beginning of the 2021 to end of 2021, or from January 2022 to December 2022. Also, it can be different from calendar date, and it can be based on fiscal year or any date that they want to choose. For example, from 1st March to 28th February. Statement of financial position contains asset equal to liability plus equity. What are the assets? Economic resources held under the control of the organization in order to use those assets and resources and generate profit. They can be property, equipment, patents, trademarks, and they can be divided into 2 categories, tangible one. They can be stock, stock, physical stock that we can put it in our storage, or it can be intangible, like patent or trademark. Also, based on the time that we are going to use those assets, they can be divided into two categories: current and non-current asset. Current asset, they can be used for, we are holding those assets for less than 1 year. So we call them current assets, like cash, cash equivalent, or inventories. And non-current asset, we are holding them for long-term operation, normally more than 1 year, property, plant, and equipment. Okay, what are the claims? Equity and liabilities. Equity: owners, investors, directors, provision of funds into the business. Liabilities: external parties for which a past transaction requires a financial settlement. Accounting equation equal to assets equal equity plus liabilities. This is one form of the statement of financial position that we can see here. It consists of assets, cash, van, stock, equal to equity plus liabilities. Equity 6,000, loan, trade payables, etc. Generally, what does it mean? What it indicates, this statement of financial position? It shows how business is financed and how these funds are deployed. It can provide a basis for assessing the value of the business. How much does it cost if you want to buy or if you want to sell this business? How much they are financed based on equity or based on debt. Relationship between asset liabilities and equity can be assessed. Liquidity and capital employed, equity plus non-current liabilities can be better assets. So we will look at it carefully and with more details, that what percentage or how much of this business is financed by debt and how much is financed based on equity. Also, there are different users that they are looking at this statement of financial position, different stakeholders. And it's so important. Why? Because they want to make decisions, short and long-term decision, that they are internal or external users. Open to interpretation. What we'll need to compare to industry and provisions, statement of positions of the other companies. Also, this statement of financial position can be manipulated. There are different ways that the companies will use in order to manipulate the financial information, data, statements. Why? Because one of the purposes, it can be maybe they don't want to pay a high level of tax, or they want to attract new investors. They want to show that they are doing well in the business market, manipulate their share price, etc. There are different accounting conventions, for example, business entity convention, historic cost convention, going concern convention, to all aspects. For example, one of them, historical cost convention. What does it mean when we say historical cost convention? Assets are shown on the balance sheet at a value based on the historical cost. So when we are going to put the data, put how much asset we are holding or how much we pay for inventories, we will refer to historical cost of those items. Plant, infrastructure, property, land, stock, inventories, etc. And whatever we are paying, after a while, when we want to reflect it into our financial performance, we will use historical cost. So if there is inflation and we paid, like 3 months ago, for one type of inventory, we paid £100, and if now at this time today, if we wanted to buy that item, we had to pay £110. We are not given permission to reflect £110. We should reflect this historical cost, £100. Dual aspect convention. Every financial transaction has two aspects, each of which will affect the balance sheet. So each transaction happened and occurred. That transaction affect two account of statement of financial position or balance sheet. Well, what are the accounting standards? Accounting standards guide the publication of financial statement in regard of presentation of financial information. There are International Accounting Standard Board, International Accounting Standard, and nowadays International Financial Reporting Standards, IFRS. And that United Kingdom, UK, has adopted some of these clauses from financial reporting standard, and they are using it as a UK FRS, or we can say UK. Yeah.